We are into another general election, and what better time to take stock of how the successive governments have done in their terms. Our new series, It's the Economy, a report card, will have data compiled exclusively by CMI for this CNBC-TV18 series, and we kickstart with a look at investment proposals under various regimes. That is a key indicator and driver of growth. First up, Anisha Jain is here to give us a quick run-through of the numbers compiled by CMI on this parameter, investments.
Well, data compiled by CMI shows that new investment proposals have seen a declining trend in the past two regimes. Now, with private sector investments dropping sharply, the public sector investment have inched higher marginally, close to 7.6 lakh crore a year, but it hasn't been able to make up for the shortfall in the private investments. The private sector investment dropped almost 35% over the last few years, from 11.83 lakh crore a year to 7.9 lakh crore a year. As a result of this, the share of private sector investment proposals has declined from over 62% in UPA1 to just over 50% in NDA2. This even as the public sector investment has increased from under 38% in UPA1 right up to 49% in NDA2. To put simply, it is the investment from private sector has been the main driver in UPA1. Today, it is 50-50 between the private and the public contribution. Sharpest declines have been reported in real estate as well as electricity sector, which had seen big investments during UPA1. As you can see on the screen, investments in mining and electricity have halved, and even real estate and irrigation investments on an absolute basis have come down from a run rate of almost 2.4 lakh crore a year to 1.1 lakh crores. Even manufacturing sector has seen a decline, though that has been at a steady pace. Now, the services sector has actually bucked the trend, riding on strong investments in roads as well as aviation sector. If we look at the data by states, we can find a significant shift in the pecking order, with Maharashtra overtaking the traditional leader, which was Gujarat, and Andhra Pradesh scoring over Karnataka in the last 5 years. We have seen huge infrastructure spends in roads, etc. in Maharashtra and Andhra Pradesh, and perhaps that's the likely reason of the outperformance. What is actually most worrying, though, is the sharp decline in net increment in outstanding investments. The ratio of new and revived investments in UPA1 was 5x the completed, stalled and abandoned projects. This has now dropped to less than 1 time in NDA2. Simply put, this means that the pace of new investments has been slower than the rate of which at which the old investments are getting completed, stalled, abandoned. To conclude, yes, there has been an increase in the public spend over the last 5 years, but it has not matched up for the shortfall of the private capex as new investment proposals continue to languish.
Okay, thank you very much for that summary of the key numbers that CMI has given us, Anisha. And now to take the discussion forward, Mahesh Vyas, Managing Director and CEO of the Centre for Monitoring of the Indian Economy, Ajit Ranade, Chief Economist at Aditya Birla Group, and Srinivasan Varadarajan, former Deputy Managing Director of Axis Bank, join us. Mahesh, of course, is the key protagonist. Thank you very much, Mahesh. Can you give us more color on this? The way in which investments totally have fallen for 3 consecutive terms. First term of the UPA, 18.9 lakh crores, and then 17.1 lakh crores, and 15.5 lakh crores for the NDA term. Can we just say this is mean reversion? After all, UPA 1 was the best year for the whole world. Even Vietnam grew by 10%.
I don't think there is a mean reversion story over here. I don't think India deserves a mean reversion to some low level that we had 15 years ago or 20 years ago. We require more investments. We have a large human capital base. We have low per capita income levels. India needs to grow much faster. India needs to not only sustain the 7% or so growth rate we are seeing right now, but we need to see this accelerate even more and take this growth deeper down, have it become more inclusive. This requires more investments. What I see very important over here over the last 3 regimes is the very sharp fall in private sector's investment. So why has the private sector, which was extremely aggressive in UPA1, mind you, the private sector investments in UPA1 was something like 8x of what was seen in the preceding 5 years. So there's this big jump in private sector investments in UPA1 compared to its preceding 5 years. Why in the last 5 years have the private sector not done the same thing? Why are they still extremely cagey and their investments are falling? That is the big worrisome factor in the story.
That brings me, of course, to how we will end it, because we're going to ask about the next 5 years as well. But Ajit, that is squarely the question posed to the private sector. So you should be giving us some answers on this. If you looked at the NDA1, which is referring to the previous, compared to that, UPA1 saw an 8x rise in private sector. Would you attribute it entirely to, a low base and growth, global factors? What went so right?
Lata, there were several factors. First of all, remember NDA1 also had the dot-com bust, and there was a deep recession. And in fact, we saw, as we came closer to 2004, a combination of declining interest rates, declining inflation, and increase in the National Highway Program. So perhaps we were at a brink where all the conditions were right for
Would you attribute that UPA1 largely to global factors, because everybody grew?
Of course, global factors. A global recession also was wearing off. I'm not saying all of UPA1 investments can be attributed to this precondition, but it was building up to be a favorable condition. On top of it, one important factor I feel was the unleashing of the PPP model, where the government was, determined to increase the share of infrastructure investment in GDP from 5% to 9%. This is still the stated objective. But government finances alone are not able to do this. So the PPP model was actually pursued with the vengeance, if I can call it that. And that meant that private sector had to participate in a big way. And of course, as you remember, bank lending to infrastructure sectors was running at some 30-35% growth rate. Your favorite governor was, expressed concerns about that.
Yes.
And so that was also contributing to this fantastic pace. And don't forget, the global economy was also doing very well. So exports were growing. So exports, which is correlated to manufacturing. So many conditions came together, and perhaps the credit growth rate was a bit unsustainable.
Let me quickly drag you to the present, which is what we are discussing. Global growth also picked up in 17-18. We have had one of the best years of global growth in recent years in 2018. Why didn't we take cues?
Exactly. So we fast forward 10 years, or 12 years later. By the way, just to point out the earlier numbers which you quoted, 18 lakh crores, 15 lakh crores. Remember, the GDP, the size of the economy in 15 years is twice as big. So actually, the nominal numbers are understating the problem.
The slowdown.
So the gross fixed capital formation has come down from 40% of GDP to 30%. It's a 10 percentage fall, not just in... So why now? So basically, I think, first of all, we are paying the price of that excessive growth in, especially the PPP-related problems. We understood that all the risk was in the private sector. Therefore, cost of delays, cost of approvals, delays, and plus also the fact that many of these delays ended up being NPAs. So now there is kind of an overreaction. So now we have in fact switched from, for example, in highways, we have switched from build, own, transfer to now toll and then transfer. So the sequence is exactly ulta. The sequence is that first the private sector used to take the risk and then transfer it to the government. It's now ulta. The government says we will take the initial risk of acquisition, of clearances, and once the toll situation is stabilized, then for the next 15 years or 30-year concessions are given to... So we are switching that. Secondly, also remember the twin balance sheet problem. I mean, we still have not worn off that. So, and then, as Srini was saying earlier, risk appetite. Risk appetite is lower. We can discuss what that means, but basically these are the three factors.
Since you said twin balance sheet, that clearly passes the parcel to the banker. Srini, was this primarily a finance issue, or was it the bandwidth of the entire administration and policy making in the 5 years? Let us discuss the 5 years, since that's what we are looking at. After all, bank balance sheets were pretty broken at that time.
See, I think you'll have to look at what Ajit was saying, that you had a burst of investment over the previous 10 years, and it was predicated on a business model which was PPP. And when private sector came in, there was an expectation of returns, and capital also came in, and that clearly was
lacking.
Did not happen. Meaning, if you are expecting a 20% return on equity, You said power, the demand is so much, you got roads so much, any real estate, everywhere the return expectations as far as equity which came in and as well as debt which got into the projects, none of it happened. The equity didn't get that return. The lenders didn't get their money back in the way they thought it would. And that, whether you call it cleanup, whether you call it consolidation, whether you call it taking stock, I think that has happened over the last 5 years. Meaning you've invested so much. Now, is it the right way to do it? Is it generating the right return for the sponsor?
Okay, so lack of returns.
And we're trying to find a way. And the model which we are trying to switch is trying to find a way from saying this is not working. Now let's see what else. I mean, who can buy this? Because clearly, and when we were discussing before the show, I was saying the sponsors have no risk appetite. Meaning today, if you ask a person, will you get 20% return on equity investing in infrastructure? No sponsor will say yes today. Okay. Whereas everyone will be saying yes. But actually, the chances of possibly getting it today are much higher than what it was possibly in 2009-10.
Okay, so this is the time.
So the risk appetite is saying that you are conditioned based on what you've seen over the last 3-4 years.
Okay.
And therefore,
take your point. I take your point in terms of risk appetite not being there now, but ought to be there. Now, how much would you give the government credit for disentangling some of the problems? Or do you think the last 5 years were only entangling? At least in power, they tried something like Uday.
Well, the complications that this government got were very
serious.
High. So UPA 2 had problems on land acquisition. I mean, the private sector faced serious problems on land acquisition. There were problems on availability of coal, gas, iron ore, and most of these problems were, in a sense, addressed in the NDA regime, in the current regime. So I think the problems that besieged UPA 2 are not the ones which the private sector is facing now. The private sector's reliance on things like PPP and government-sponsored projects is a bit too high. That's bound to be the case partly because those are the bigger projects. But I think I would expect a little more investment from the private sector into the manufacturing sector, which is currently constrained because the capacity utilization is very low. If you go by OBICAS of the RBI, the capacity utilization is 74%, plant load factor is 60%. These numbers are extremely low, cannot motivate the private sector to invest. So I think while there was a big boom in investments in UPA 1, there were problems, severe problems in UPA 2. Still investments were high then. Around now, there seems to be a demand problem. And complications of the old PPP not delivering returns, as Srini is saying, and demand being low has put investments on a low scale. I wouldn't blame the government, except for saying that a diagnosis of the problem and some proactive action would have been good. But this is a post hoc analysis.